Hi, everybody. Welcome back to Dividend Stockpile. Today, I'm joined by Jeff Schwarte, Chief Equity Strategist at Simplify Asset Management. We're going to be talking about two of their brand new Barrier ETFs, XV, the Simplify Target 15 Distribution ETF, and SBAR, the Simplify Barrier Income ETF. These funds are designed to give investors equity upside and income with built-in downside protection. And Jeff is here to break down exactly how they work, what makes them unique, and how it might fit into your portfolio. So with all that, Jeff, welcome to the channel.
Thank you, Jeremy. Happy to be here.
Yeah, I really appreciate you coming on. We've had a couple conversations with the folks over at Simplify, and you guys are always so gracious with your time to talk to the community about your wonderful products. And with that, you guys have so many unique and innovative ETFs that I wanted to really get you on to talk about these two brand new ones. I mean, these only started back in April, but I feel like they are the new innovation in ETFs, this Barrier ETF style. So before we get into the details of these two funds, can you kind of give a little bit of background about what you do, maybe what Simplify does?
Yeah, so I joined Simplify in April of 2024 after a 30-year career at Principal Financial Group and managing about $80 billion for assets for Principal. Joined Simplify just because, the unique nature of Simplify is we're actually allowing investors to get more targeted outcomes for investors. The way I think about it is we provide solutions that provide protection, participation, via leverage, income, or diversifiers in investors' portfolios. And the genesis of the firm forming was a regulation change that happened in 2020 that allowed derivatives to be used in ETFs. And our firm has really embraced that particular idea of using derivatives, swaps, futures, options to give investors more defined outcomes. And I think that's the call that I had to come here, was to be able to serve as our chief equity strategist to help oversee the platform of equity offerings, help bring new relationships to the table, as well as promote and write thought capital and help our sales department to educate clients and to be able to help people make informed decisions for outcome-oriented solutions. So the culture is great, the innovation is top notch, and really love working here at Simplify.
Yeah, that's one thing I love about Simplify is the amount of innovation your products really do offer. And I totally get with, there's a lot of change in 2020 where you guys were able to expand what ETFs can offer. You guys really took that and ran with it. I think you have dozens of ETFs at this point, specifically in your income sector. I think there's like 8 or 9 that I saw that you guys are continuously innovating with new product features, new outcomes, as you said, new strategies, depending on what your needs are for the client. Some of us are looking for that super high yield monthly income. Others are looking for a moderate yield plus dividend, like a growth aspect. So you guys really do offer everything. That's why I love having you guys on the channel to talk about all these new products, so people can pick and choose what works for them. I'm not here
exactly. I think the way I frame it, Jeremy, is that we offer tools that have been around for kind of more accredited investors through the hedge fund world. So we're actually taking a lot of those concepts. These aren't new concepts; they're new to the ETF wrapper. So, we had a call this morning with somebody asking how do they get access to SBAR, which we're going to talk about today. And I said, he goes, what's the minimum? I said, $26 a share.
Right.
So we don't have these lockup periods. We don't have the minimum investments. We don't require accredited investor status. It's a publicly traded wrapper. And for $26, you can get exposure to these strategies. So
absolutely, the strategies and the management behind it. You guys, like yourself, you have over 30 years of experience. I know a lot of the other people on your team have decades of experience as well. So we're able to access that knowledge and that experience in these new wrappers, to your point, for one share at a time. And so it's really a great time to be an ETF investor and to be an income investor, because we do have access to all these great products. So with that, on a very high level, I know we're going to dig into a presentation you have in a second, but these are considered barrier ETFs. So can you explain on a very high level what a barrier does for an investor?
Yeah, so what a barrier option contract provides is an outcome-based solution with an income stream. So we're selling a barrier option, so we get money in. We're going to buy treasuries, and then we're going to take that premium, and then we're going to distribute it to investors over the term structure of the position, right? So when we get these barrier options, they're typically 1 year, and they'll typically have some sort of threshold if the underlying reference index closes below that barrier level. So it's a barrier of protection, I guess you would call it. If the reference index closes below that threshold of 30% in the case of SBAR, the investor fully participates in that drawdown, a contingent drawdown. But if that reference index is down 29%, there's no participation. So you get paid to take the risk. And if you look at, on a rolling 1-year basis since 1990, there's only been 7% of the observations where you've broken a 30 barrier. So the probability is quite evident at the beginning of the position. So 93% chance you don't break the barrier and you get paid handsomely with low double-digit yields. That's a pretty attractive income stream for investors that traditionally have relied on fixed income or dividend yield or REITs or utilities for what I would consider very modest monthly income streams.
Myself personally, I do option selling as part of my income strategy. And so when you're writing a call or put, obviously you're taking on that obligation if it fulfills that you have to, sell or, whatever your position. But with a barrier strategy is you have protection up to a certain amount that there's no real obligation to you. It's only if it exceeds that threshold is when you're obligated to fulfill that contract. And in the case of an ETF, it would just be like a loss on the contract, but it just all works together. So having that downside protection is great, but because you're selling it, you're receiving income while you're doing that. And personally, I've been investing for about 26 years. And so I've seen most of those drawdowns that you were talking about. And they're very few and far between. There's definitely more up than there are down years, especially a 30% down year. And so, the risk reward trade-off is not too bad, and you get paid to do it while you wait. So I think this is a great idea that you guys have presented here. So I'm going to pop up your presentation. Maybe we can just go through that so you can explain it a little bit more in detail.
Yeah, sure. So the two offerings that we launched April 14th, just under 4 months old, is the Simplify 30 Barrier ETF. So that one's going to have a reference barrier of 30%. And we're looking at 3 different underlying indices: S&P 500, Russell 2000, and NASDAQ. And we're doing what's called a worst of. So you look at the performance of the worst of those 3 at the expiration of that position. If it's below the barrier, you participate. If it's above the barrier, you don't participate in the particular drawdown. So that one, by definition, we have 30 embedded in the name. We'll always have a 30 barrier, and we'll generate whatever income the market's allowing us to generate. So that's going to come from treasury yields as well as the vol surface of what we get paid to sell that option. The second ETF is XV, ticker symbol XV, Roman numeral 15. As you can surmise by the ticker symbol, we're targeting a 15% yield. Now, we're going to do whatever it takes to get that 15%. That may mean we change the barrier level set to, say, 20 or 15. We might change, instead of 3 underlying universes, we might only target 2. So we're going to make best effort to achieve that 15%. So depending on the investor's appetite for yield, obviously everybody wants more with less risk. Those unicorn investments don't really exist. But in the case of SBAR, you can expect a 30% barrier as your constant. Whatever the market gives you for income, we're going to distribute. The other way with XV, you're targeting a yield, and then you change the variables or the levers in the portfolio to achieve that return target.
Yeah, that makes a lot of sense. And it's nice to have 2 different options depending on your risk tolerance and your income needs. Getting a not guaranteed, but a target 15% income level is very appealing to a lot of investors, but they may not be willing to take the risk of what it takes to get there. So they can then switch over to SBAR, where you know what your downside limit is, and you're just willing to accept whatever income comes based on the market conditions. And if I read it correctly, you guys are doing new contracts pretty much every month. So it's like a rolling 12-month basis.
Yeah. So this is what we want investors to not have to deal with is some funds or ETFs in the marketplace are calendar based, a January vintage, March. Those are typically in the buffer world. We wanted an evergreen type solution. So investors don't necessarily have to think about, well, do I buy the January vintage or the February vintage? We're going to just give investors exposure to a laddered approach of positions. Those positions are delivered via swap, and it's a worst of particular exposure with a very unique feature called a callability feature. So the callability and the worst of enhance that option premium income that we get. And the way the call piece of it works is, let's say we write a single contract at the beginning of the year, January 1st, we get a premium, we buy treasuries, we invest that capital that we receive from the option contract. At the end of the month, if we have a non-call 1-month term structure, if at the end of the month, all 3 indices are above the initial value, that particular instrument gets called away from us. Now, remember, the premium that we got was for a 1-year term structure. So we get to bank that total coupon that we received from the option contract and then redeploy it into the next month. So you could have a series of calls throughout the year where these things, again, you're going to utilize premium. It's not like an interest fixed income instrument where you have to give back part of the premium for the period you didn't hold it. You get to keep that entire premium if it gets called. So what we'd like to see in a best case scenario is equity markets going up, all the positions getting called every week or every month, depending on the term structure. We redeploy that capital and get multiple calls throughout the year. As we've talked about before, the drawdown potential is there, so we call it contingent downside if we exceed the barrier. What investors are thirsty for is high monthly income, and that can come from lots of derivative approaches, whether you're doing put spreads like some of our strategies or selling the VIX or lots of different ways, but this is using a very specific option called the barrier option. What the advisors gain on the right-hand side, we partner with several entities to develop both these products. There's a regulatory burden for compliance departments with structured notes. And again, structured notes, it's a $300 billion industry. Advisors can get those structured notes today. It's kind of a pain to negotiate. You've got to constantly monitor them. You have a little bit of higher fees. I mean, a lot higher fees, like typically 2% to get into these types of targeted outcome solutions. So we've democratized that process for advisors. You can buy it Monday, sell it Thursday. Not that we encourage that, but there's no liquidity constrained with these particular products. So high monthly income, potential per drawdown, depending on the conditions of the market. We enhance the yield through worst of and callability features and kind of a laddered approach, so we don't have a particular position that's going to dominate the portfolio. Again, 93% chance historically that you don't break the barrier. That's pretty good odds from my perspective.
Yeah, definitely. No, it all sounds great. Can I go back to the callability feature?
Sure.
So if you were to write an option or sell an option on your own and you did it for a year, but then wanted to get out of the contract, you'd buy it back, buy it to close. And
Correct.
that would cost a little bit of premium. But what you're saying for this callability feature is just built in, that you can call it back without having to refund any of the premium that you received?
100% correct. Yeah. So you're basically underwriting a derivatives desk at a major bank. You're underwriting if the market becomes really, really ugly. By exceeding that barrier, you're actually providing them a hedge to their portfolio. So that's why they want to buy. They're basically buying insurance from us. And as long as we don't have an event, we get to keep that premium. Kind of like auto insurance. Jeremy, you write a check for auto insurance. If you don't have an accident, the insurance company keeps it. So we're essentially underwriting the insurance needs of a derivative desk at a major bank, and you get paid to take that risk. And so the callability feature is an income enhancer. It allows, it automatically happens. There's no discretion. At the end of the month, after the non-call period, if the reference indices are above the initial value, automatically gets called. We take the capital, we bank the annualized premium. Now, there is a little bit of embedded, by getting the weeds for a second, there's a little bit of time value of money and a little bit of a discount to that option you're right because of the call feature. But again, you equities go up more than they go down. So we would expect, a significant number of calls throughout the year. I don't know, maybe a third of the portfolio. I'm just giving a ballpark.
Yeah, they say that the general market, S&P 500 goes up, 7 or 8 out of every 10 years. And so, you definitely have that upside tilt. And then for those worst case scenarios, the negative 30 that we're talking about for our SBAR, I mean, that happens very rarely, to your point, 7%. So you have really good odds. So let's hop on to the next page, and just so we can get through all the information that you have. But yeah, it sounds great so far.
Yeah, so just to compare and contrast the two, we're going to be focusing on a 1-year tenor. No leverage, so we're doing 100% of notional value. The SBAR is going to have the 30 barrier, which is highlighted here. The income will vary. XV is going to have the target of 15, and the barrier will vary. Underlying indices, S&P, Russell, NASDAQ. Callability feature, typically it's a non-call for 1 month, but we have the flexibility to do 2 months or 3 months, depending on yields. And then we ladder them, so we can ladder them. What we've done lately is ladder them more on a weekly basis. So every Friday we have something maturing a year from now. Again, the product's only about 4 months old. Now, in rare opportunities or rare instances, like for example, in April this year, call options were dirt cheap. And we do have the ability, because of our expertise with derivatives, if the market becomes very, very difficult and we see an opportunity to protect one of the positions from breaking that barrier, we could conceivably, it's in the prospectus, we could protect that by buying a put option on that underlying exposure. So on the right-hand side, just for setting expectations with investors, is that there is flexibility, again, to preserve the capital and to generate that income for investors, that given our expertise, we do in rare instances expect to provide a little bit of protection or participation depending on what the market dynamics present themselves. So again, I have to say it, but it's not a core part of the product.
Yeah, so there's so many moving parts here. It's good to have managers who know the market and know what you guys are doing, and have the time and effort to dedicate to looking at this. If you were trying to do this as an individual investor, it'd be a lot of your time. So having it professionally managed goes a long way. All right, so I think we pretty much talked about this slide. So it really shows that you have the 30% barrier on SBAR. Once it goes past that, then the barrier part of the ETF takes a loss, but that's just on one contract of the multiples you have. And so at the end of the day, you're not taking a full loss, but it is technically a loss for that one particular contract.
Correct. And just to point out, Jeremy, it's only on the last day of that option contract. Throughout the year, if the market's down 20%, you could have unrealized volatility, unrealized losses and gains, right? But it only matters at the end. So if the market's down 29.5, you're not breaking the barrier, no downside, right? So it's important for investors to know that there will be some unrealized losses throughout the journey, just like with any option contract, you have mark to market of the different legs. In this particular case, it only matters at the end of the term structure.
No, that's a good point to highlight, is that it has to be at the end of the term. Okay, perfect. All right, and then talked about this.
This is probably my favorite slide in the deck. On the left-hand side, we have a typical outcome-based visual. So no matter what happens, we're still going to distribute a consistent dividend. So your income is going to come from treasuries and selling the put barrier option with auto callability as something that we hope happens quite a bit, right? That's where you get the bank the annualized premium. But at a minimum, no matter what happens, that's what we're providing. And investors are very thirsty with 10,000 baby boomers retiring every day. People want income, right? So then what happens really with the NAV? That's the variable that is uncertain, right? So if you have a market that's up 16% on the right side of this presentation, your NAV is not really going to change. Just to clarify, this is not an upside participation product. It's geared towards, I'm using a 30 barrier at 10% income as the threshold here. So if the market's up 16, you're going to get a distribution yield of 10. Your total return is 10. So, okay, you like the market in an up market. Okay, great. Now, if the market's down 28%, so below the barrier, not exceeding the barrier, but it's close to the barrier, you're still going to get the 10% income, but your total return is still 10%. So again, you're above the barrier, so your return is 10%. If you break the barrier in the third example there, the down 33%, your NAV is going to go through the barrier, and so you're going to get full participation on the way down, but that gets offset by the 10% distribution yield, so you're down 23. So the way I think about it is any return less than 10%, you always outperform. If you want upside participation products, SBAR XV are probably not that vehicle because it's geared towards income and that need for monthly income. So that's how the product's designed. It's not an all-weather product, but it does a really good job of distributing a high level of distribution yield for investors. And that's the biggest category right now. We're seeing massive growth is derivative income solutions, whether it's put spreads, VIX selling, barrier options. I mean, we do them all here at Simplify, and it's a very attractive way to diversify your sources of income from stocks, bonds, utilities, and so on and so forth.
Yep. And if you're a true income investor, what you're looking for is that stable monthly income. The capital appreciation is not as important. It's a secondary factor, but really that consistent income that you can count on is a huge part of the appeal for a lot of income investors. Yeah, you'd love to see some upside, but you also want to get that monthly income no matter what's going on in the market.
Correct. And Jeremy, honestly, I get this question a lot. What's the counterparty risk? There is none because we're actually selling an option, or we're selling a barrier option to the counterparty. So we have the capital at the beginning of the term structure, right? There's no counterparty risk. There's no credit risk because we're not buying individual bonds. Whatever duration risk you're going to have is going to be in the form of the treasuries, which is, there's 6 to 12 month treasuries in the portfolio. So the the duration, credit, counterparty risk is very manageable and very minor.
Yeah.
The slide that you're showing here is that callability feature that allows us to enhance income. And then the worst of, you can buy a listed option on the exchange with a single reference index. To do what we're doing, you have to do it through a swap, which is the worst of. And so when investors look at the portfolio, there's going to be a description of each of the positions. You can see the maturities, you can see the counterparties, very transparent approach. We've had tremendous interest in these products because it does provide attractive yields with a known in advance. The whole benefit of derivatives, in advance what the outcome looks like, and investors have complete liquidity. Just from an operational perspective, we've heard a lot of advisors love the idea that we're monitoring these positions for them, and that it's professionally. We get favorable terms because we're going to negotiate with various counterparties to get the best yield possible for selling the option, and it's professional tools and systems and people to monitor this for investors.
Yeah, that's great. I love the worst of, because there's sometimes where the Nasdaq's down, the S&P's down, the Russell's down, but you're looking at all three and only having to worry about the worst of them all if they hit under. So that's a very interesting feature that you don't necessarily get. Can you talk a little bit more about the variability on the XV side of things?
Yeah. So really what we're targeting there is, we know investors would love to have more versus less when it comes to income. And what we're going to be doing there is we're going to be targeting whatever levers we can pull on that would achieve that 15% distribution yield. We're going to take advantage of in the market. And so if we enter into a very low vol market, so volatility drops significantly, obviously selling that option, you're not going to get as much premium income, right? So then you're going to have to change the barrier from 20% to say 15%. And again, all this is on our website, and investors can kind of see what we're up to. So think of SBAR as being very systematic. We're always going to target 30%, whatever the market gives us. XV, there's about a bit more active management. We're going to be looking for attractive opportunities by changing maybe the non-call period, the reference indices. Maybe NASDAQ's got more volatility as of late and allows us to get higher premium. We might just do it on worst of two, for example. So that's the idea behind it, is more active management to get higher returns. You are taking more risk with that particular approach. I think the vol for XV investors should think about it right around 15%. SBAR, we're targeting like a 10% yield with a vol around 10. So 10, 10, 15, 15, just to kind of give people a gauge of what vols they might expect. In a perfect world, you have a upward trending market where there lots of the positions get called, and your NAV is extremely stable, and you're banking all this income, which is great. In some ways, it's trying to make a better version of a bond with some equity premium. And I've been an equity investor my entire life, and I think it makes sense that investors that have enjoyed massive capital appreciation in the last 20 years, now they want to convert that income. And this is a nice, easy way to do that through a single ticker symbol or two, XV, XBAR, depending on your risk appetite, allows investors to convert that capital to income.
Yeah, exactly. I mean, I always say when you're retired, capital appreciation doesn't pay the bills, but cash flow does. Right. So when you're in that mindset where you're looking for that 10% income or that 15% income, like that's the priority. And so these hit great. So just to recap, it looks like XV, you're targeting that 15% yield. SBAR, you're close to that 10%, but you have a little bit of a smoother ride, if you will, because of the volatility is reducing that product. Obviously, those aren't guarantees, but those are kind of your target at this point.
Yeah, I think that's how we would think about it. One thing we haven't talked about, Jeremy, is the taxation. Investors should think of this as ordinary income.
Good to know.
Not qualified for some of the special treatments of some of the derivative contracts, but just think of it as ordinary income. And typically later in the month we have the X date, and then dividends get paid shortly after or close to the month end. So again, monthly paychecks, higher yields than most products, known variables of what your risks are going into it. To me, it's a very attractive opportunity for investors that want to do better with their capital.
Absolutely. And these are some great options for people to investigate. Okay. So the last question I have is, because it's actively managed, what is the management fee on each of these, just as a reference point?
Yeah. So both of them, we charge 75 basis points. We think it's a very attractive price. Even if you take a percent off the yield, you're still double digits. So
Yeah.
we think there's a lot of value for investors with these particular approaches. And we on our website, simplify.com, we've got thought capital, we've got papers I've written, we've got videos. So beyond this great podcast, if you need more information, feel free to go to that website. And we try to make our website a bit different than others and give you a lot of visibility and blogs as well as videos.
Yeah, I love the blogs, the deep dive videos that you guys do on all your products. Yeah, you guys are very open and honest about what's going on over in each of the funds. So I really appreciate that. I'll definitely put up all the contact information for Simplify on the page. Just to recap, we're talking about your new Barrier ETFs, XV, the Simplify Target 15 Distribution ETF, and SBAR, the Simplify Barrier Income ETF. Jeff, really appreciate all the information you're able to share today. Thank you for coming on, and we'll talk soon.
Thanks, Jeremy. Have a good day.
Thanks. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.